All right, so we are pursuing our work that we have been looking at, exploring statistical arbitrage opportunities using machine learning strategy. This is the paper that we have been discussing, written by Jean and Du and Yang. So, what are we talking about now? What's up on our menu? On our menu, we now have um, a situation whereby we need to explore uh, this trading strategy design. This is very, very important. So far we have looked at core integration. We've chosen our stocks because we were looking for two stocks and we got the pair. Of course, and obviously, I said we are going to discuss better ways of actually finding our stock. But now we have got it. We have done the core integration. Now we know that these two are actually co-integrated. It means that they have got this long run relationship that is positive. And now we need to look at the trading strategy design. So this is the work that was done by the authors, and they talk about trading signals, including opening and closing and stop loss, all those things. They discuss these things in order for us um, to get a clear understanding of what is going on. But what is a trading strategy and how do you implement it? So, one of the things that you need to know is that when you are implementing a trading strategy, you must be uh, cognizant and account for real world trading factors. So you must be cognizant of and account for real world trading factors which have got indirect or direct influence on the performance of your strategy. So your strategy will perform, but that performance is going to be driven by other factors other than the data that you have got. So, which factors? Like transaction costs. And if you look at equation 5 there is a C, which is actually looking at trading cost. And the question is that all? What about slippage? Because slippage occurs when the execution price of a trade differs from the expected price. And that is due to market volatility or maybe delays in order execution due to one reason or the other. All right. So to incorporate slippage, it is something that you might want to consider, and so that you can have a better reflection of the actual execution prices. All right. Then also you need to look into your assets, the very assets that you're dealing with, like how liquid are they? Because sometimes they might not be all that liquid, all right? Because less liquid assets may experience larger bid ask spreads. So the spread that I'm talking about is the one that you can see here. Let the spread represent represent the decentralized spreads. So M spread here is representing decentralized price spread. So all these things you need to put them into consideration, amongst others. Of course, you can talk about risk management. You can talk about monitoring and adaptation, and all those things. But you can't include everything in a model, can you? Because as it stands, that is a model describing how you are going to talk about your price spread. All right. So the next thing now that we want to talk about, because what is important is that in financial markets, trading has got a lot of risks, inherent risks, and no strategy can guarantee profits. That is very, very important. And so what we then look at is, in the context of trading itself, there is this thing that we talk about, the long position and the short position. And these were used by the authors a lot. And it is very, very important at this particular point in time just to go through this, even though these seem to be trivial. I mean, if we didn't describe GACH, obviously you know about the long position and short position. And in a long position, an investor buys an asset with the expectation that its value will increase over time. That is the long position, all right? So the investor goes long by purchasing the asset and hoping to later on sell it at a higher price, all right? And in a short position, an investor sells an asset that they do not own. So they have to borrow money so that they can sell an asset that they do not own with the expectation that its price will decrease. So if you sell an asset now at 100 and then its price goes down, then you buy the bag again. So how do you make your profit? You are going to profit from a short position when the asset's price falls. So here are the two examples that I can give to you quickly. You are looking at a stock with a current price of $50. If you go long and buy 10 shares at $50 each, your investment is 500. All right. But if the stock price increases to $60, because this is a long position, so you are buying now, hoping that you sell later at your profit at a profit. But if it is a short position, you go short if you sell 10 shares at $50 because the current price is still $50, all right? And then you get 500. Then you hope that later on with time, the price is going to go down to $40. You sell all 10 because they are not yours. You need to have them back. You get 400, you make $100 profit. So these are some terms that are used by the authors that I think they are worth discussing, and we might have done a good job about it. So to finish this discussion, let me give you a word of warning. It is important to note that short selling involves borrowing shares, and there is an obligation to buy them back later. So short selling also carries higher risks as losses theoretically can be unlimited. And if the asset price rises significantly. So losses can theoretically be unlimited if the asset price rises significantly. And in your trading strategy that you're going to choose, you may decide to take a long or short position based on your analysis of the market conditions, the trends, or other many factors. It's very, very important. So that is as far as our discussion for about the long position, short position, and the spread, and all the other things concerning with concerned with trading strategy are concerned.